Hi, this is Damian Lynch with Fuel Communities. As with all product types nationwide in commercial real estate, we are in a soft market for the sale of multifamily. This has even affected our strong Southern California markets. This summer nationally, there were a slew of industry articles talking about a 20% year-over-year drop in pricing for multifamily for Q1 and a 70% drop in sales. This is hardly what we experienced in Southern California. And while there were a reduced number of buildings being marketed, we saw that the asking prices were staying fairly stable. For the last webinar we did on this subject, we researched the Great Recession from about a decade ago. We shared data on LA, Orange County, and the Inland Empire, how those markets fared compared to the rest of the nation, specifically those markets outside of California that investors considered opportunistic or hot. In that webinar, we discussed how Southern California markets seemed to trail these other markets going into the Great Recession by about 3 months and had recovery happening about 3 months sooner than those other markets. The impact on pricing, occupancy, and rents were also much less severely impacted than those other markets. We're seeing a similar trend now. The first half of 2023 saw inventory and sales numbers reduced, yet pricing has remained level, unlike the drops in value other markets around the nation are seeing. One factor in the lack of inventory, which is keeping pricing stable, was the availability of 3 to 4% interest rates in the prior 2 years. This is helping many property owners weather this downturn cycle. There are not the same number of apartment buildings facing unrefinanceable debt because of high interest rates as there were in 2008 and 2009. Now we are in the second half of 2023. Treasury securities are at 5%, and we are finally seeing some reduced pricing on inventory in Southern California, while rental demand remains strong. There are enough owners on adjustable rate mortgages or companies that have exits planned for this year that we are starting to see some reduced pricing opportunities coming to market. Just as in previous cycles, this seems to be trailing the national average by about 3 to 6 months. So at Fuel Communities, we started offering aggressively on some of these buildings because there is some renewed interest in Southern California multifamily. This was affirmed at a recent investor conference. The feeling was that while it may be challenging to navigate through California's governmental restrictions, the strong demand, the prohibitive cost and time and resources to build new buildings, along with a strong economy locally and the limited supply of existing housing, overcomes those governmental restrictions and thus enhances the value of workforce housing. And that is the product type that Fuel Community goes after. And this is why we stay in our region. Even though rent control and other bureaucratic irritations California has implemented make work more difficult, there is simply a lot of safety in the stability of the employment opportunities and the labor that the second largest MSA in the United States offers. The jobs mean renters. The sheer breadth and diversity of the local economy ensures that there are jobs and thus rental demand. Also, in a geographic region bounded by the ocean, there's little developable land, so there's a permanent supply constrained situation in the greater Los Angeles area. To couple that with strong rental demand, existing workforce housing that is the affordable rental option for most households ensures the continued value in both rental rates and resale pricing. While there are no assurances that rates are going to come back down to 2021 numbers, there are quite a few news organizations and sources out there predicting 5% rates by the end of 2024 and rates back down to the 4% range in 2025. Our strategy is going to be to acquire well-priced product now, which make economic sense now at their existing income and paying market interest rates. Thus, if rates decline and rents increase as are predicted, we stand to enjoy some healthy profits. The conservative approach is that we're still profitable at existing rates and we're not pitting our future on some future expectation. We hope to acquire as much as we can in this period of uncertainty because if past cycles have taught us anything, this period before the next market ascent are when the most lucrative purchases are made. So, if you'd like to enjoy some passive income offered by real estate investing without doing the heavy lifting yourself, contact us about our latest offerings, and let's see if investing alongside our family works for you and yours. Thank you very much.